Hi everyone. So today we're going to talk about the differences between three different types of provident funds. So all these three provident funds are an excellent tool for planning for your retirement. So what these three tools are, what these three funds are, we'll be talking about these in detail and we'll be doing a side-by-side comparative analysis. So this is PPF, Public Provident Fund, EPF, Employee Provident Fund, and VPF is Voluntary Provident Fund. So I hope this will help you because I've done a side-by-side analysis. This will help you to compare the differences and benefits, and you can choose which one is beneficial to you so that you can plan which one do you want to invest in. So first of all, who can invest in an EPF account or PPF account? And if you see, I'll talk about VPF when we go ahead. That is a part of the EPF, and that is why it is not in a separate tab because it is combined with the EPF account. So who can invest in an EPF account? Only salaried employees can invest in an EPF account. And who can invest in a PPF? Anybody can invest in a PPF account. This is why I have highlighted this here in bold. So wherever you see something that I've highlighted here in bold, that is a benefit that one of the fund offers over the others. So only salaried, whether public sector or private sector, does not matter, but only people who are in a private sector job or service can apply for EPF, but PPF anybody can open. So even if you are an employee and you want to open a PPF account along with EPF, yes, you can do that. You can have a PPF account along with your EPF account as well. So as the name suggests, EPF fund is offered by Employee Provident Fund Organization. This is all the rules are governed by this specific body, EPFO, whereas PPF, this is offered by select public and note here some private sector banks and post office. So earlier, it was only offered via public sector banks. So you would walk into SBI or PNB bank, but now private sector banks like ICICI, HDFC, Axis, or many other national banks are also allowing you to open a PPF account with them. But this ultimately is held by the government, even though government has authorized private sector banks also to open PPF accounts on their behalf. What is employer contribution in case of an EPF? So employer contribution means if you are contributing X percentage of your salary to your EPF account, the employer will match it. Yes, so if you are contributing 12% of your salary to this account, the government will the employer will also match that. So 12 and 12, 24% will be deposited to your account. Whereas in case of PPF, because there is no employer involved, you're opening it on your own. Whatever amount you deposit will be the amount that is going into your account. What is the minimum investment in PPF and EPF? So first, let's talk about PPF. So government has mandated that the minimum amount is 500 per annum. So if you want to keep your account active, you should keep depositing at least 500 rupees in a year to keep your account active. Now for EPF. EPF is done as a salary deduction. So when your employer is paying you salary, they will deduct that EPF and deposit that on your behalf into your EPF account. But what is the minimum investment? So the government has mandated that at least 12% of your basic salary has to be submitted has to be deposited by the eligible employer into your account. Now, what is this 12% comprised of and what is an eligible employer is what we'll talk about. So the government has mandated that 12% of your basic salary should go. So let's say if your total salary is 10 lakh rupees per annum, and for assumption 5 lakh rupees or 50% is your basic salary. So that becomes your base. So you'll divide that by 12 and reach out to your monthly salary. So that will become your basic salary, not the 10 lakh full complete 10 lakhs. So 12% of your basic salary goes into your EPF account, and 8.33% of that goes into employee pension scheme account. Now, what is this pension scheme? Again, this is a separate part of EPF, wherein you are eligible to receive benefits like the pension that the government employees receive. So the minimum amount of investment that the government has mandated is that you can deposit 8.33% of your basic salary, but there is a catch here. only up to a maximum of 1250 per month can be deposited into your EPS account. So let's say your salary, basic salary is 15,000 per month, right? So 12% of that would go into your EPF account, but again 8.33% of your 12% that goes into your employee pension scheme account. 0.5% of it also goes into employee deposit linked insurance. So this is like an insurance, like a life insurance that you have. So 0.5% of it goes into that as well. So another benefit of EPF is that not only are you getting benefits like PPF, you're also getting benefits of pension. You're also getting benefits of employee deposit linked insurance. I'm not going to talk in detail about what a employee pension fund is, what a employee deposit linked insurance is. For now, what we need to understand is you get some additional benefits if you are investing into EPF as well. Now, who is an eligible employer? Any organization who has more than 20 employees is mandated by government to statutorily deposit 12% of your basic salary to the EPF account. Now, for employers who have less than 20 employees, they can still opt for EPF and they can offer that to their employees. And the amount, the minimum investment, the government has made it 10% there. So the employees may choose to contribute up to 10% of the employees' basic salary to that account. Now, if there is minimum investment, it has to come with a maximum investment because these are excellent retirement benefits and government does not want everybody to contribute everything to their long-term retirement funds. So for PPF, it is very simple. You cannot deposit more than 1,50,000 rupees in a year. So you divide that by 12 and then you can come at your monthly amount. You can choose whatever is the amount you want to deposit, but it cannot be more than 1,50,000 per month. And that you may decide to deposit all 1,50,000 in a year on the first day of the year or the last day of the year, or you may contribute equally, but you cannot deposit more than this amount. Now, what is the maximum amount for an EPF? It is 88% of your basic salary for VPF. Now, this is where VPF comes into play. The government has mandated that you can contribute 12% of your basic salary towards EPF. But if you want to contribute more than 88, more than 12%, you can choose, you can opt for a VPF and contribute up to 88% of your basic salary. This is what it mentions here. So the benefit is that if you think this scheme is really helpful to you and you want to contribute more than the minimum amount, you can specify that percentage to your employer, say 2%, 5%, 10%, and that will get deposited into your EPF account. So if let's say government is already mandating 12%, then you can also choose, let's say you choose for 8%, then 20% will be going into your EPF account. But the catch here is that the interest earned on employees' contribution, if it exceeds 2.5 lakh, if your contribution to EPF plus VPF exceeds 2.5 lakhs in a year, now as per a recent government notification, that will become taxable. So you have to consider that if you do not want any of this amount to be taxable, then you have to keep your contribution, and that is only employee share, not the employer's share. So while employer is contributing 12%, you can leave that out for this calculation. So if your employee's contribution only is up to 2.5 lakhs, your interest will not be taxed. But if your contribution, your share exceeds 2.5 lakhs in a year, then any contribution above that, the interest on that amount will get taxable. What is the interest rate as of June 22? So the interest rate that is offered on PPF is 7.1% each year, whereas that as of today is 8.1%. So if you see, EPF is highly beneficial here because it not only offers you 1% interest rate that is higher in this year. So every year, whatever amount is getting contributed, so your interest is getting calculated on the total amount, including the interest as well. So this 1%, when seen in a long run, say 20, 25 or 30 years, it makes a huge difference. Now, other difference is the interest on EPF is compounded monthly, even though it is deposited at the end of year. The interest in PPF is compounded yearly. So whatever amount you're contributing, say you're contributing 10,000 each year in PPF and 10,000 each year in EPF, So the interest will be calculated at 7% on 1,20,000 for PPF, whereas in case of EPF, so interest will be calculated on 10,000 in the first month, 20,000 in the second month, 60,000 in the sixth month, and then 1,20,000 in the last month. So that ways, you are getting your interest on the basis of your monthly contribution, and that is why I have highlighted that in case of EPF, not only the interest is higher, but the interest is compounded monthly, which is a huge benefit. Now talking about the tax exemption, I think most of you are aware that under Section 80C, 1.5 lakhs is something that you can claim for your contributions in a year. So for PPF, the tax exemption under Section 80C is up to 1.5 lakhs, which is up to the maximum investment that you can do. In case of EPF also, the maximum amount that you can claim as a reduction is 1.5 lakhs. So that is the same. Now, what is EEE? EEE means exempt, exempt, exempt. Yes, it means, so the first E is your contribution exempt. Second E is the interest that you are receiving on your investment exempt, and the third E is are the withdrawals exempt. So in case of PPF, everything is exempt. So the contribution that you're doing is exempt. The interest that you're earning is exempt. When you withdraw your PPF, it is exempt. You will not be levied a tax on that. Now, in case of EPF, the first E is your contribution. So your contribution up to 1.5 lakh, like I mentioned, is exempt. But the catch here is if you choose to opt for a VPF, which is higher than 1.5 lakh per annum, you cannot claim a tax exemption on that amount. Your exemption, even if you're contributing 2.5 lakhs or 5 lakhs per annum, you will not be able to claim a tax exemption. But if your long-term goals are that you are okay with 8% interest rate, which is compounded annually, compounded monthly, right? If you are aligned with this interest rate, then you can still continue to contribute more than that amount, even if your contribution is not giving you tax benefits higher than 1.5 lakhs per annum. The second E is interest, we've already talked about. So anything, the amount, if your amount exceeds, your contribution each year exceeds 2.5 lakh, then the interest on that amount becomes taxable. But if you stay below it, then it is exempt. The withdrawals are exempt with respect to a condition, and we'll talk about it right now as well. So it is also EEE EPF, but with respect to a few conditions. Now, this is what the tax on withdrawal is. If you withdraw your EPF before 5 years, then there could be a tax. We will talk about when and how you can withdraw, what is the lock-in period. But the condition is if you withdraw your money from EPF subject to those certain conditions, your amount will become taxable. For PPF, like I mentioned, it enjoys a EEE status, so your withdrawals are not taxable. Now, we just touched based about lock-in period. So what is the lock-in period for EPF? If you are retiring from a company, then yes, EPF allows you to withdraw your money. However, it will become taxable at your current slab rate. So even though you can withdraw this amount, but that amount will then become taxable. So sorry, this was for resignation. So if you are resigning, there are two options. You can either transfer or withdraw your money. If you are transferring, then there is no tax on it. If if you resign from one organization, joined another organization, you can just opt for transferring your EPF. That can be done online as well. But if you have resigned and if you plan to withdraw, then your amount is not withdraw, then your amount is taxable for 10%. However, in case of the other one is retirement, you can withdraw your money after you have retired. In case of PPF, what is the lock-in period? So in case of PPF, the lock-in period is 15 years. There are some conditions of how you can withdraw, and that is the next point that I will be covering. What is the liquidity requirement? But the lock-in period for PPF is 15 years. Since it is a long-term investment for your retirement planning, you will have to consider or plan your finances very carefully. Do you need that amount for those 15 years or no? Then after you have completed your 15 years, you will have options to extend it with or without contribution. That is, do you want to continue contributing to PPF, or do you want to just keep it open without any contributions? And you can extend it for in a block of 5 years each. And in case of PPF, there are partial withdrawals that are allowed after 7 years. So you cannot withdraw your whole or entire amount, but you can withdraw that partially for after 7 years for some specific reasons. Now, this is the liquidity that I was talking about. So in case of EPF, you can withdraw your amount in case of special cases like marriage, education, medical expenses, or you need a home loan, for repaying your home loan. So EPF allows you to withdraw this amount in case of special cases, but PPF, it does not allow you to withdraw until at least you've completed 7 years. You can avail a loan on your PPF account between years 3 to 6, but you cannot withdraw that amount. That is allowed only after 7 years. So there is some, and that also you cannot withdraw complete amount. For example, you can apply for 50% withdrawal after 7 years for some specific cases, again, like marriage or education or medical expenses. So this is a comparative analysis between EPF and PPF. I would say these are great tools. I know there are other funds like NPS, mutual funds also that give you higher return, but this is an excellent risk-free tool because this is not linked to markets, and this gives you compounding interest. So if you continue, if you are consistent, if you keep investing a good amount in each of these accounts monthly, then after 15, 20, 30 years, you will be surprised what huge corpus that you have built for yourself. I hope you find this useful, and let me know if there is anything else that you would want me to do a comparative analysis for, and I can try to look at that video. Thank you.